Thank you for joining us at Loan Risk Advisors. Today we're going to do a training, and in particular we're going to look at marketing compliance in the mortgage world. Let's go get started. Welcome to our module on marketing compliance. I'm Ray Schneischerl with Loan Risk Advisors. Marketing compliance is one of the most common regulatory issues flagged by the states, and even in the federal government, the CFPB will issue consent orders for those lenders who are not complying with marketing compliance requirements under the federal law. Okay, so here's what we're going to cover. Now, many people feel that marketing compliance is kind of a mystery, and I can understand why. There's a bit of an art and there's a bit of a science when it comes to marketing compliance. But in this particular video, we're going to talk about the types of marketing that is subject to the legal requirements, why marketing laws and regulations even exist, and then kind of touch upon the difference between prescriptive and non-prescriptive marketing requirements. Let's first start off with what really is marketing subject to marketing compliance. It's a good question. Essentially, anything you put out to a consumer where the consumer thinks that it's marketing is basically marketing. So what are we talking about? Well, pretty much TV ads, radio spots, direct mail, blog posts, social media, and website banner ads, just to name a few. Keep in mind, again, it's not about the media or the medium that you were using for marketing or for advertising. It's how the consumer will digest it or understand it or receive it. That's what matters as to whether it's marketing or not. Well, let's just hit a couple quick examples to show the distinction. So let's say we're working on recruiting on social media. And to do that, to entice people, you're going to say, hey, we can close loans in about 11 days. Sounds good. Is that going to be marketing? Okay, a little bit of a trick question in fairness. Depends on where you're doing this. If you are using social media that you use to also do outreach to consumers, let's say Facebook, and you're doing this to recruit to people in the business, but consumers can see it as well, well, then you might want to consider it marketing. Why? Because what the consumer is going to hear is that you can close loans in about 11 days. For them, they see that as marketing. Of course, you see it as recruiting, but they see it as marketing. Now, you try maybe LinkedIn or something else, maybe it's not. Again, these are not definitive answers. I'm giving you an example of the fine line between what marketing is and is not. Okay, I want to go quickly on another one because this one comes up often. Let's say that you have an employee that's posting, let's see, contact me for loans. I can offer rates as low as 6%. Well, is that advertising? I think the lean should be towards yes. And what makes the distinction here? Well, if you have an employee who is using their own Facebook profile, but in that profile says that they are employed by you, right, and they're doing outreach through social media, well, guess what? That now becomes your marketing, even though they're the ones posting it. And as a result, that which they post will be subject to marketing compliance requirements. It's a little bit tricky. Now, this is why some companies have policies whereby the employees are not allowed to identify themselves on Facebook as employed by you or by a lender, or that they can actually do anything related to mortgage on the personal profile. All right, let's go quickly and talk about the laws that are in play here. Now, under federal law, we have Regulation Z. We have the MAP rule, which is the Mortgage Acts and Practices rule. We have UDAP, so Unfair, Deceptive, and Abusive Acts Practices. We have the Fair Housing Act, and then of course then we have state laws as well that govern marketing. So there's a lot of elements, a lot of places that we will see the marketing requirements. There's a lot of similarities in all of them, which is helpful, but they're all not all the same. So why do we have marketing requirements? So let's explore this a little bit. Really the goal, the regulatory goal here, is to ensure consumers can easily identify marketing material and understand the message pretty clearly. So in simpler terms, marketing laws and regulations for both prescriptive and non-prescriptive marketing compliance are designed to prevent creditors from deceiving consumers in any way. Examples of deceptive practices include maybe using confusing languages or graphics, or creating a false sense of urgency to the consumer, or maybe hiding important explanations in the fine print. That's really the purpose of these regulatory requirements, is to make it more clear to the consumer. Okay, now I've been using the term prescriptive and non-prescriptive throughout so far, and we will be talking about in greater detail what that means in other videos. But suffice it to say that prescriptive requirements are really where the requirements themselves have very specific details. If you do this, then you must do that kind of requirements. Non-prescriptive are more principles-based. So basically, you shouldn't do a bad thing, but don't give specifics on what they mean about that. So that's the difference between prescriptive and non-prescriptive. Okay, so now let's move on to the next modules and go a deeper dive on some of this information. Welcome to our module on marketing compliance. I'm Ray Sneischer with Loan Risk Advisors. Now, as we covered in the previous module, prescriptive requirements are those where the legal and regulatory guidelines clearly specify what must be in or out of your marketing materials. While prescriptive requirements may initially seem straightforward, you will come to understand that even these clear-cut guidelines can be challenging. So let's go kind of give you some examples of prescriptive requirements. So for example, there'll be requirements that you have to avoid blind mentions. So like many states require that marketing materials cannot be blind, meaning you must include the name of the advertising creditor in the marketing material itself. Creditors should avoid including the name of the borrower's current lender or using government emblems to make their materials appear official. And while we won't list all prescriptive requirements here, these guidelines are generally quite clear about what you must and must not include in marketing materials. Let's dive into the federal marketing compliance requirements really quick. So look, simple. If you include a simple interest rate in a marketing material, you know that you need to include the annual percentage rate as well. Now look, I know this sounds simple, but then you're going to be asking, well, APR, I'm not even advertising a loan and loan size and loan fees, so how do I come up with the APR? Good question. Short answer is come up with some kind of an example loan upon which you are advertising so you can create the APR. I don't know, maybe a loan of $100,000 and $150,000, probably loan amount that you're most used to, or average loan amount size with the average kind of fees. That's what I would do. But again, the requirement is if you have the interest rate, you must have the annual percentage rate. And to be clear, the annual percentage rate has to be at least the same size as the interest rate that you were disclosing on that advertising. Okay, now let's talk about Regulation Z and trigger terms. Now let's go over them. Here, if you mention any of these, the amount or percentage of any down payment, the number of payments or period of repayment, or the amount of any payment or the amount of any finance charge, then you must also disclose the down payment amount or percentage and the repayment terms, including full term obligations and any balloon payments, and the annual percentage rate, and if applicable, stating that the rate may increase after consummation. Okay, what am I saying? Basically, if you say certain things, you got to say the other things. Prescriptive, right? If this, then that. So again, look at Regulation Z for the details, see how it works in your world. But that's a prescriptive requirement under Regulation Z. Also under Regulation Z, they have a lot of requirements relating to ARM loans. And particularly, it's about making sure that when you advertise ARM loans, you're not advertising to look like a fixed rate loan. So for example, if you have a loan that has a fixed rate period and then goes ARM, you're not advertising it as a fixed rate mortgage when in fact it's an ARM loan with a fixed period. So there are very particular requirements in Regulation Z regarding to ARM or adjustable rate mortgages. Okay, now let's just jump into some examples. So give you an example. In California, if you're licensed by the Department of Financial Protection and Innovation, you need to indicate that in every piece of marketing. That is that you were specifically licensed by the California Department of Financial Protection and Innovation. Some states prohibit or limit the use of the borrower's or the consumer's current lender. I know that's sometimes used to kind of give them attention, saying your loan with so-and-so, which is a current lender. Some will either limit that or absolutely prohibit it altogether. There's going to be laws that limit what you can do with emblems and things that look like you're a governmental entity. States also don't like it when you use super superlatives, so best and lowest in particular, right? So we give the best rates or we have the lowest rates. Those are not actually permitted in many states in using that terminology. Look, these just kind of highlight some of the ideas and the nature of the prescriptive requirements in certain states. There are many others, but I thought I'd just give you an example of what some of those look like. Okay, let's explore some kind of real-world examples here. Let's say you're putting advertising and you include a proposed payment amount on a loan such as, I don't know, $2,300 without any additional information. Is that okay? Well, technically, no. That's a payment. That's a trigger term, as we talked about under federal law. So if you disclose a proposed payment, that triggers the need to include additional information like the amount or the percentage of down payment, the terms of repayment, and the APR. So the possible solution here is include a statement, maybe something to the effect of, based on a 30-year loan amount of $250,000, loan-to-value ratio of 75%, payments of $1,000 per month for 360 months at a fixed rate of 5% and 5.25% APR. To be clear, I'm not sure if the numbers actually make sense to do the math, but you get the idea. Put the additional information in there, because if you did this, you got to do that. That's what you get with prescriptive requirements. Look, the other way, of course, to do this is just simply to avoid using proposed payments in your advertisement so we don't have to worry about the trigger terms. Okay, let's say now you want to advertise an interest rate. So let's say you put 6%. Is that okay? Sure, but don't forget, you got to put the annual percentage rate. And both the interest rate and the annual percentage rate have to be equally prominent. That is, one can't be brighter or darker or bigger or smaller than the next. I will tell you the annual percentage rate can be more prominent, but it can't be less prominent than the interest rate. So the easiest thing is to make sure they kind of have equal prominence, and so you can read that. So what's the idea here? If you're going to do interest rate, don't forget the annual percentage rate and make sure it's accurate. Or, again, one way to do it, avoid putting interest rates in your advertisement so you don't even trigger the requirement to begin with. But again, interest rate, APR. If you do this, then you must do that. So I kind of went quickly over prescriptive requirements, but you kind of get the idea. If this, then that. That's what you're getting. And it'll be pretty much detailed as to what you need to do. Let's move on and talk about non-prescriptive next. I'm Ray Sneishel, Loan Risk Advisors. In the previous module, we covered prescriptive requirements, which are the requirements that clearly outline what must be included or excluded in certain advertising. In this module, we'll delve into the more nuanced world of non-prescriptive advertising requirements and explore why reviewing these requirements is often more of an art than a science. So what do I mean? Well, most marketing compliance laws, and the biggest challenge for those conducting marketing reviews, dealing with the requirement that say the advertisement must not be deceptive. That's it. It doesn't say what deceptive is. I mean, there are often kind of examples or some kind of allusion to what it might be, but it's not this, therefore that type of things that we see in prescriptive. So therefore it's non-prescriptive. It's more of a principle. Just make sure that what you put out there is not deceptive. But we don't know what that always is until we see it later. That's what you get with non-prescriptive requirements. While it's clear that straightforward, honest statements aren't deceptive, and blatantly misleading statements are deceptive, the middle ground is really the subjective area that we navigate here. We often face situations where an advertisement seems benign until another reviewer, maybe a state regulator, later determines that it's deceptive. So we know it when we see it approach isn't helpful. So we are dealing with the fine line between legitimate marketing fluff and misleading statements. You don't want to be called a lying sack of statements, and that's really the issue. So let's explore this more closely. Let's talk about how to avoid being deceptive. Okay, well, avoiding confusing or incomplete statements will help, right? So using phrasing that is confusing or incomplete can unintentionally create a deceptive situation. This often happens when trying to convey a lot of information in a limited space or with few words. For example, saying low credit score okay and lots of cash out could mislead consumers into thinking this is like one product. That is, it allows for low credit scores and a lot of cash out, when in fact maybe these are two separate products. It could be deemed deceptive. So even if that's not the intention, that's the result. The solution is to read and review the marketing material from the perspective of a consumer who doesn't have a lot of experience in financial services industry like we might have. Another thing you can do is avoid using unsubstantiated statements. So verify the accuracy and support with data. So making bold claims about your lender's products or performance is common. Statements like, we close loans in 7 days, or we make more VA loans than anyone. It sounds impressive, but are they true? Can you substantiate them? Ensure the consistency here. You'll need data or other proof to verify these claims. So performance statements should reflect typical performance and not anomalies. When you're talking about closing in 7 days, is that the one time you did that in 10,000, or is that usually what you do, or it can be done in a good percentage of cases? Think about that insofar as when you're using the data or using statements like that. Also, keep in mind you should retain the documentation upon which these statements are made, because you will be challenged at some point, and you want to be able to show the information to back up, to substantiate the statement that you made. Avoiding misleading official statements and symbols. Emblems and words that suggest the advertisement is coming from a governmental agency or is endorsed by a government agency, or otherwise creating a false sense of urgency is generally not permitted. So using emblems that resemble HUD's emblem, or phrases like urgent or time is of the essence when it's not applicable could be problematic. Use caution when using the consumer's current lender information. Avoiding using the consumer's current lender or services name in advertisement is probably a good idea. In fact, as we mentioned before, some states prohibit or even restrict that practice. Avoid using reference numbers in marketing material without the proper context. So for example, if you have a number that, particularly if it shows through the window, some kind of random number that makes it look like official, maybe a loan number or something to that effect, that could be problematic, especially if that number has no real use. Now in the past, for example, I've had a client where that number actually was useful for marketing purposes. They were able to use that number in their marketing system. If they put it in, they can find out exactly who the consumer was. But the point is, by using numbers or reference numbers, sometimes make things look more official than they really are. And so you should be considering that, or it could be problematic in an examination. Be careful with window envelopes. So we understand you could have information in, for example, direct mail piece. But what shows through the window, does that cause urgency? And maybe the false sense of urgency. Again, official emblems, maybe numbers, maybe an urgent message about your loan. So certain phraseologies, but it shows through the window, causing the consumer to open the envelope. Let's look at some real-world scenarios. For example, you want to use a direct mail piece and you're going to have green paper. Is that going to be an issue? Well, materials written on green paper might appear to be an official statement from the IRS. I've seen this happen before. So what's the solution here? No, avoid using green paper. If there's other reasons to use it legitimately, maybe. But what I'm getting at is, insofar as using the type of paper, that could be problematic. I've had situations where the leadership team would like to show that they have a lot of depth and experience. And so they would put something like 20 years experience as a team. And while that was true, the company itself was only 3 years old, so how is that possible? So the implication was the company itself is more than 20 years old and has experience, when in fact it was only 3 years old. Yes, the leadership team was together for 20 years, but the company itself was only 3 years. So how do you do that? Maybe you got to broaden the language insofar as saying that the management team has been together for 20 years as opposed to the company. Something I see often is lower your payments by getting a cash out loan to pay off your credit cards. Okay, that kind of makes sense, but this could be deceptive without explaining that the consumer may pay more interest over time using a 30-year loan than to pay off their credit cards in a short period. And that makes sense. While it might be a lower interest rate, they're paying that lower interest rate over a longer period of time. So in fact, the accumulated interest for that particular loan might be more than if they just paid their credit cards in 3 years, although it was a higher interest rate. Again, these are things that regulators look for, and so if you were able to explain that into your advertisement, it probably takes some of the sting out of being accused of being deceptive. Get a cashed out loan and your monthly payments will only be $450. Now, here's what happens with this. I've seen this happen before. That payment amount is sometimes going to reflect the additional money on the mortgage associated to the cash out. So numbers might not be accurate. $100,000 loan, you get $150,000 with $50,000 cash out. And what they're advertising is $450 of payment reflects the $50,000, not the $150,000. So in that instance, the best practice is to have payments that reflect the entire $150,000. Put another way, regulators don't like it when you are going to take out only the cash out piece and advertise that is $450 payment for the cash out piece, but it looks like it's the entire loan. That could be problematic. So the solution here, show the full payment of the full $150 in that example. I want to make a quick statement on fine print. And I know we always have the sense that in marketing material, particularly in direct mail piece, we have a lot of fine print, and a lot of it's correct. But we do have to be careful on how we use this. There are certain elements in marketing that must be clear and conspicuous, which is different than information left on fine print. The clear and conspicuous standard requires that clarifying language in advertising must be placed with equal prominence and in close proximity to other language it supports. Look, fine print might be suitable for statements like, terms and conditions apply. Not all applicants will be approved. All loans are subject to underwriting and approval. Loan product relevant information such as assumes a credit score of 680 and higher, owner-occupied dwelling, something to that effect. So some things may be okay in fine print and not necessarily clear and conspicuous like I was talking about. But here's the big caution on fine print. Do not expect fine print to fix or make compliant statements that are deceptive or confusing. All text in marketing, including fine print, should effectively communicate the message. Statements in marketing materials should not rely on fine print to fix the statement. They should be fine to begin with. That's the underlying premise of fine print. It's not to hide something. It's to help the consumer clearly understand what he's getting into or that it's marketing material, and which is the whole reason for marketing compliance to begin with. So that's pretty much what we've covered, is the prescriptive requirement, non-prescriptive requirement, why we have the laws, and maybe ways that you can comply with this law. Now, there's a lot of detail. This is not legal advice, so you have to look at how what your marketing material might look like and the steps that you want to take to make it compliant. But this is intended to be a framework of how you can comply with marketing. Welcome to our training on marketing compliance. I'm Ray Sneischerville with Loan Risk Advisors. In prior modules, we talked about different marketing requirements, the prescriptive and non-prescriptive types. In this module, we'll just do a quick recap on marketing compliance and how you can maybe work it in your shop. So again, to recap, marketing requirements come in two forms. Prescriptive requirements that are clear and straightforward. If you do this, you must do that. Pretty clear in what you have to do, and for the most part, it's not ambiguous. Non-prescriptive requirements, well, these focus more on you can't be deceptive and make sure you're sending a good message. But it's not real specific. It's nuanced issues and almost like an art form sometimes to read something to make sure you understand what you're saying and whether it's deceptive or not. For prescriptive, know the requirements. If this, then that. Just know them. For non-prescriptive, read the marketing material as if it's read by a consumer who doesn't have a lot of experience in mortgage lending, because that's going to be the measure as to whether the marketing material is deceptive or not. Things you can do. So audit marketing material. Regularly review all marketing materials for compliance with prescriptive and non-prescriptive requirements. Train your employees. So make sure that they understand what's clear, what's non-deceptive, what's prescriptive, so they understand what the requirements are as well. Establish clear policies. So establish some policies about how marketing works, and particularly on social media, who can do it and who cannot, and how it's done correctly. If you have some employees who are going to advertise on Facebook, for example, make sure that there's a step by which you can review that marketing before they post it into Facebook. Consult compliance experts. Okay, well, it goes without saying. Remember, this is not legal advice, and particularly because in the nuanced environment with non-prescriptive in particular, your situation may differ from one or the other. So the marketing needs to be reviewed by someone with some experience. So I always say consult a compliance expert when reviewing your marketing material. Document your processes. So keep detailed records of marketing material reviews and approvals as well, because that's going to be requested by state examiners. Stay updated. So always know what the updates are and what the standard is for federal and state laws regarding marketing. Maybe annually. Learn what they are. See if there's anything new. And always test yourself to be better. So that's basically marketing compliance. So these modules were intended to address marketing compliance as broadly as possible. Again, how this applies to your world will depend on your particular marketing material. But hopefully this created a framework by which you now know what to look for, at least the questions you need to ask to make sure your marketing material is compliant. Thank you for taking your time with Loan Risk Advisors and Marketing Compliance.